Thank you, panelists, for joining us today. Let's get started. And if you want to kind of give us a quick overview of what lending looks like as we speak today. Tim, you want to start?
Sure. Kyle's got a little bit different situation because of the way that that Greenstone gets their funding and things. It's a little different than the normal mortgage market. So I'll fill you guys in on what's going on in our market. I really could probably spend 30 minutes talking about this, but I'm going to keep it real short. Essentially, there's a liquidity crunch that's going on in the mortgage origination side, having to do with the fact that there are a lot of loans locked because rates came down. A lot of people refinanced. There's a lot of loans locked right now. And at the same time, rates dove even further. And that's causing a liquidity crunch on the mortgage side based on how mortgage hedging works on the lock side. So you can ask me more about it. I'd be happy to get further into it. But essentially what we're seeing is mortgage companies are having to tie up a lot of cash into these things called margin calls. So as lenders are getting margin calls, there's a real cash compression, which is causing them to need to be able to sell loans profitably. And then we've got another crisis going on in the servicing side of things because, as you may have heard, Fannie and Freddie loans are able to be pushed out, put into deferment for a month. Government loans, they've announced that those can be in deferment kind of indefinitely. And the problem with that is the servicers still need to make their payments to the bond servicers. And the reality is most of the time they're getting payments from customers and making these payments no problem. And now, usually they've got cash on hand in case a few people aren't making payments, but now you've got this big chunk of people not making payments. And that's putting a real cash crunch on the servicers of mortgages. So because you've got these two things together, it's causing the problems that you guys are starting to hear about in the government loan market, because there's servicers that don't have any appetite for buying more government loans. And so it's causing a bit of concern in this government loan market, which is probably a lot of the things that you guys are hearing. So I'll pause and let Kyle jump in.
So Kyle, I think you need to unmute.
Okay. So this one, can you hear me now?
Yes.
Are we a little bit better? Okay. Sorry, we're still working through this. Some it's better on the phone, some will go through the computer. So we'll work through this together. So for Greenstone, we portfolio everything that we do. We don't sell to the secondary market. But what we have noticed is that the way we get funded is through farm bonds that get sold to the market. And the investors are not willing to put the money into the farm bonds or invest in them. They're looking to just hold cash. And so what we've noticed, at least from Greenstone's standpoint, is we've actually had to increase the rates on the farm bonds that we're selling, which in turn increases the rates that Greenstone can offer to consumers. So a lot of times we're getting questions of, why can I go to Dart Bank or another institution and get it at 3.5, and Greenstone is at 4.25, and it's mostly because of how Greenstone gets funded. But that allows us, so our criteria really hasn't changed. So our underwriting criteria is roughly the same. We don't have any, guidelines from Fannie or Freddie or anything like that. So as far as, our pre-approvals and pre-qualifications and things like that, those really haven't changed. But it's just kind of our rates have not been as low as what people saw in the first week of March or something like that. So that's kind of the market that I'm seeing, at least for, the kind of high acreage stuff that Greenstone does and the vacant land.
Some things to watch out for.
Oh, go ahead. Go ahead, Tim.
Some things to watch out for is across the board, lenders are becoming concerned about employment and things of that nature. And so do know that companies are probably going to be verifying employment up to the last day or a few days before loans are closing. And so if you have clients that are potentially going to be laid off, that could impact their approvability on a mortgage. Thankfully, we haven't seen any of that yet in our pipeline, and we are moving forward. We're fully staffed. Everybody's working from home, but we're keeping things rolling. And as problems come up, we're solving them. And I'm hearing that across the business, that as problems come up, lenders are working on solving them. But do know that if layoffs or things like that are happening, even up to the last minute, those could affect approvability if people are being laid off or their employment is being changed in some way. So that's something to think about. Appraisals, another thing that people have been kind of curious about, and I think you've been experiencing. Appraisals are still happening. They are considered essential, and so appraisers are going out there. There's some different guidance across the industry. A lot of times people are saying, well, try to do an interior exterior appraisal. If for some reason you can't get an appraiser that's willing to do that for COVID reasons, you might be able to get a drive-by or desktop appraisal. So Fannie and Freddie are becoming a little bit more on the conventional loans, a little bit more lenient on the kinds of appraisals that they're allowing in this time, which is nice.
Mm-hmm.
So that kind of leads to another question that we had. Is there anything that buyers can do now if they're temporarily unemployed? And can we start with Shelley? We haven't heard from Shelley yet.
Thanks, Megan. One of the things is if their employer is continuing to pay them through this marketplace, if they have a pay stub, that's still considered them working, and we'll close with that. If for some reason they are laid off and unemployed, then we do definitely have to wait to close on those, because with this situation, we don't know when they're going to go back to work. We hope soon. That's our own hope. But so if they're still getting a pay stub, we're working around it with getting a copy of a pay stub or something. If their employer isn't at work where they can verify employment or something of that nature. So we're getting creative with the documentation rather than having to go to the employer. But if they are unemployed, unfortunately, we're going to have to postpone the closing until they're back to work.
Tim and Kyle, is that what you're experiencing as well?
Yep, there are definitely ways to do alternatives to getting somebody on the phone for verification of employment, like Shelley was talking about. Or yeah, Shelley was talking.
Yeah, we as far as Greenstone goes, generally it relies on the FSO or the loan officer to make sure. The only time we really do the final verification of employment is if we have PMI on the loan. So if it's a conventional and they've supported it and credit's approved it, obviously credit's gonna not approve it if somebody's not working. But if they're still being paid, and we can show that, they're just temporarily going through this hardship or something like that, we could probably still work and get it approved and get it closed.
We have a couple questions that came through the chat. So when laid off, there's no approval. Is that an automatic thing? Or
Yes.
it's going to vary based on lender, based on loan program. I think there just is a need for some clarification on that.
Right, and if they're laid off where they are collecting unemployment, we have to delay the closing until they're back to work. Now, I did see a question come up from a realtor standpoint. Because you're self-employed and you can't work right now, doesn't necessarily mean that for the year you're going to be your income's going away. So as self-employed individuals, we are going to take and average your last 2 years of income and still be able to do something for you in that regard. So it's a little different situation than we had before, because now you're actually able to maybe get some benefits from this, but we're looking at the long term, and that's why we average your income to get you qualified.
Yeah, and there, I mean, you might see underwriters across the business ask for like a profit and loss or something like that in a self-employed person. With real estate, the good news is, although you can't necessarily show homes and things right now, you are working with clients. You do have clients going through. You still have loans that are closing. It's not as if you're completely laid off in that sense, and you aren't necessarily a business that's been shut down completely. If you have someone that's in fencing, for instance, putting up fences and it's not essential, and the government order says not essential, maybe Shelley, maybe you guys are treating this differently, but I think there should be a level of let's try to think through this. Let's try to get in front of an underwriter to get an answer. If we have somebody that's self-employed, even if they've got the 2-year average, if they're considered to be on the as a part of the non-essential that cannot work at all, I think it's something that you at least want to ask an underwriter about on the self-employed side. But for real estate, I would assume that you're going to fall into the category of we're able to prove that you're still working, and so that 2-year average, as long as numbers aren't too far off on year to date or something like that, should be fine, like Shelley's talking about.
Right.
There's also a question here. I had heard Caliber is not funding. What and who does that impact?
Well, that can impact, all of those loans that are in process with Caliber need to be redone. And I think that that's going to be something with like what Tim was talking about earlier, that this cash crunch is going to affect some companies that aren't strong right now. And so you're going to see some of these companies that may have done loans in our area before are not eligible to either fund the current loans or do any more new loans because of this cash crunch. Again, I think that the Federal Reserve is aware that this is causing an issue, and that's going to be a potential housing situation that they need to get going, and they've created a task force to try to attempt to get to the bottom of this so that we can still have our housing market still going. But in the short term, that can create some problems for deals that you may have out there already.
Another question we have, and we also have Eloy joining us now, is it getting harder for buyers to get approved? Are guidelines getting stricter? Is like higher credit scores required now?
Well, I mean, there are some credit score implementations, the government loans especially. So we're seeing those on our side. The 640 and below are probably not going to be in existence for a bit. Conventional, they may still allow stuff with home ready, but it's hard to say. There's a lot more complexity involved than just an actual score. There's the whole credit profile, what kind of reserves that a client might have. So I can't stress more than ever that buyers need to fully disclose, as much as they can to their mortgage officer when trying to get something, because there might be something that we don't see initially. So, I mean, full disclosure, doesn't matter how great it is. Hey, I create Etsy stuff, and I sell it online, whatever the case may be. We want to know all the particulars because it's just only going to better the file from an initial standpoint.
I think it's
Thanks
helpful
for
that
joining
you just
us,
said
Eloy.
case by case. Case by case is more true than ever. I mean, it's always been true in the mortgage business that every borrower is a little bit different in terms of their overall situation. Even more so now, just really important to go through a thorough pre-approval.
So what about transactions that are already in progress and started prior to the shelter in place? What's happening with those right now?
In our case, everything's running as usual. We are processing. We're all working from home. Underwriters are working from home. Closers are working from home, and everything that we have started, we will be able to finish. So we are not having any difficulties in that manner at this point, and do not look that we'll have any difficulties in funding loans coming forward. Just as some of those things change in the governmental loan sectors, you may see just a little bit higher rates on those loans because there's less of the availability there.
And Shelley, to your point earlier, because you mentioned, some companies that have been, doing loans in the area, might not. It's a real good reminder that having a good, solid lending partner that you're working with, that's a really important thing, because you want to be working with a company that's got a good reputation, has good, solid cash reserves, because you may see a couple of these companies. I mean, Caliber's a big company, and I don't know exactly all that's going on behind the scenes there, but it's just really important that you've got a connection with somebody like Shelley or Eloy or Kyle that's going to be working for a company that you can trust in these uncertain times.
Kyle?
Well said.
So can you maybe talk about some of the differences that are occurring from lender to lender?
differences.
I'm sure all of us on this panel don't know what other lenders are doing right now, which is kind of creating a little bit of question. So that's a great question that we can all answer for you. Lender to lender, most of us are going to be going business as usual. There will be some changes in some of those things that we will do probably case by case, as Tim said earlier, you know, as things change in the FHA arena or things of that nature, letting our customers know if they had a customer that maybe qualified, like Eloy said, with a 640 or higher, or maybe had a 620 before that we were going to do, but now we have to have a 640 to do that program. I'm sure all of us will reach out to our clients and realtors to let them know if something's changed to make the customer they're working with maybe not eligible during this temporary situation.
Yeah, I guess I think that was well said. I don't know if I can add a ton to that. I mean, yeah, there's different. Yeah, I've got a couple other friends in the mortgage business, and it seems everybody's treating it a little bit differently in terms of, you know, yeah, are we going, you know, only brokering government loans now, or are we you know, raising the rates like Shelley said, or are we you know, are we going to wait to lock until it clear to close? Right now, currently on purchases, we aren't going to that extreme yet, but a lot of companies are trying to reduce the amount of loans they have locked in their system. So there's all sorts of different things that companies are trying to do to reduce risk. I think it's just one of these things where communication with the lenders that you have in process right now is important to make sure everything's on track. But I think assuming, like Shelley said, that business operating as usual, especially for those loans that are going through right now, and then as new loans come into the pipeline, as new pre-approvals are coming through, you know, obviously the case by case analysis. I'm going to mention this later too, but I think it's important to realize that this cash crunch that's going on is a very it has a lot of things to do with the current situation with the virus and, you know, inability to work affecting servicers, and, you know, this massive change in rates over a short period of time. It's ultimately going to be something we look back on months from now and say, wow, remember when that happened? And I think trying to nail down where every lender is on every one of these items is going to be kind of dog chasing the tail there, because I think you're going to see these things changing day by day. And I think it's important for us to look at our pipelines and say, you know what, we've got a lot of people that want to buy homes, and we've got people that want to sell homes, and whether that's going to be right in this period, or if that's going to be next month when things start to get lightened up, or 2 months from now, I think we're going to see, whenever this thing comes out, I think we're going to see a lot of pent up demand hit the market. So it's really important for us to make sure that we're keeping our databases clean and making sure our buyers are ready to go, because you're going to probably have, you know, a lot of activity in the market. And so I think the people that are prepared and keeping in touch with their clients, building those relationships, making sure they're setting themselves up correctly for, you know, being employed and staying in those situations where they can get income verified, and making sure they're ready to go and they know what their purchasing power is. I mean, the more that we have, the bigger database we have of these people that are ready, willing, and able when all this stuff comes out, and when we're looking kind of in the rearview mirror, the better position you're going to be super profitable. So I think there's definitely uncertainty in these times, but I think there's a lot of hope for the agents that persist and are ready to hit the market running when things start to open up, because it's going to move fast when things do.
Yeah, I think from Greenstone standpoint, we've been kind of, I guess you would say, unique to the market, where our standards are pretty high already. So normally we aren't accepting anything under a 680 credit score. Most of our loans are conventional, require 20% down unless you're buying a primary residence. Then we can look to add PMI. We're not really selling to Fannie and Freddie, so we're holding all of our stuff, so we don't feel that servicing crunch because we service all of our own loans. However, we primarily don't offer the rate lock up front. We actually don't lock the rate until we've passed all of the hurdles. And it's because how Greenstone receives their funding that if we lock the rate and say the appraisal comes in low, or the customer doesn't want to close, or they lose their job, we're required to charge them a 1.25% fee for locking that rate and then not closing on the loan. So to avoid that, we don't lock the rate until closer to closing. So a lot of this stuff that's occurring really is kind of how Greenstone's been operating the whole time, which is a little bit different. But we have a lot of cash reserves. We have a ton of cash ready to fund. We're, saving a lot because of the farm market. And, that's kind of been in a downturn for the past 4 or 5 years. So we have a lot of cash reserves. But like I said, like everyone's saying, just making sure that your customers are pre-qualified. And if they have the lower credit scores that you're aware of, just touching base with the lender and making sure that they can still move forward to closing. But from Greenstone standpoint, we're pretty much in the same boat and everything's going the way we normally have done business.
I just want to share quickly, we do have some questions that came in, and Bill McLeod with Case Credit Union is also on with us right now, and he put in the chat that at Case, it's business as usual. Other than what's been said, they are also looking at loans in progress and verifying applicant is still employed or still receiving a paycheck. So I just wanted to throw that out there too. We do have a question. Do you have suggestions for those who can't make their payments and how it will affect their credit score?
Well, I think that if somebody's definitely in that scenario, they most certainly want to get with their servicer, mortgage, to figure out a plan, because unfortunately, not paying, or if they just don't make any kind of plans or any communications, and it's reported to credit that a late payment, that is going to impact their credit score pretty nicely. So any efforts that they can do, and it's just going to be a servicer by servicer kind of thing on what's available for them, but that's definitely a best way to do it. Is if the inevitable happens, it's going to affect the score.
Yeah, I mean, I would say from Greenstone's standpoint, we currently are offering if the customer reaches out to us, gives us their explanation of their situation, we're offering a 3-month payment deferral. So they can either take the remaining term and divide those payments into the remaining term, or they can extend the term by 3 months, sign some documents, and get a principal and interest. Now, if they have it escrowed, they are still going to be responsible for that escrow payment, when it comes due. So if it's short, they're going to have to come up with that. But we pretty much, that's what we're offering. But like Eli said, it's going to be on the customer or the borrower to reach out to the lender to identify what programs they have. The interest rates that we had a couple weeks ago, or the beginning of March, the lenders, I feel like, at least I was reaching out to customers saying, hey, rates are really low, let's look at doing a refi. But in this situation, I'm not actively looking at my portfolio and calling customers and asking them if they're in a financial hardship. So it's going to be on them to reach out to us and say, here's my situation. And then we can offer them, whatever program we have at that time.
And most lenders are, in most cases, going to do a forbearance during this time period, because this is not because the people don't want to work, it's because they can't work in a lot of cases. So if they go to their servicer, I'm going to send an application that's for Fannie, Freddie, and FHA to you guys there at GLAR, that if they want to, they can have and at least get their borrower started on that application process, so that they can go to their servicer and say, I would like to try to get the forbearance program since I'm off work, or those type of things, where a forbearance will allow them to miss anywhere from 1 to 3 to 6 payments without being in default, and then add that on to the end of the loan program. Most lenders are working with that forbearance due to the federal government kind of expecting them to do so, but definitely want to make sure they have that in writing before they stop making any payments. Otherwise, it will go on late onto their credit report, and that's what we don't need right now in this environment, if we can help it.
So Tim, you had kind of alluded to this earlier about, you know, when things start to open back up again, there's still a pent-up demand for housing from both buyers and sellers. If the rest of you could all kind of give some advice on what agents can do to be proactive and get those clients ready for when the market does shift back. Can we start maybe with Kyle?
Sure. So for me, it's just basically touching base and just making sure that if they're with Greenstone, that their pre-qualification is up to date. Usually I'm going to reach out to them and let them know that it's coming up and we need to resubmit. But if you want to touch base with the client and make sure that when, you know, the market comes back and if they're kind of putting everything on pause to purchase, that, you know, all their paperwork's in line and we have everything that we need. But as far as our underwriting and stuff like that, if they've gotten a pre-qualification from Greenstone, that's still intact unless, you know, they've missed a payment or they're not working or something like that at this point.
Yeah, I'm going to say that agents, if they can encourage their buyers or potential buyers, clients, and same thing as we are all going through our pipeline and see who are pre-approved, reaching out, making sure nothing has changed, or if some buyers might need to be like, hey, I have to maybe pay some debt off, or I need to live off a credit card, and they're building up these balances, or maybe they took a HELOC out of their home just to get some equity out to get through some of these times. You know, just if anything changes with their financial landscape, just to stay in connection with their lender so we can make sure that all the numbers are accounted for. But to encourage them, I mean, it's still business as usual. Nothing has changed. It's still all about documenting, having your income in place. All that's still good. We're still going to be selling and buying homes, and there's going to be lending of all kinds. You know, are there other hoops to jump through? Sure, there always is at some point. But for the most part, for all of us, it's business as usual. And when we come to an obstacle, we handle it. Again, clear communication on all parties. I think that's just a good business practice.
Tim or Shelley, did either of you have anything to add to that?
I agree with what Eli and Kyle said, but it is business as usual. We are 95% of the people that we're working with now, and that's in our current pipeline, will be able to close a loan in most general cases, subject to the employment piece of the pie here. But most often, all the regular programs that we have, we will find funding for. We've seen a lot of the specialty programs lose their funding or cut back because of the liquidity problem in the marketplace. So, you know, portfolio loans, those type of things from that standing are probably the first ones to go. But our traditional programs that we do every day, and Tim can probably help me out with that, but I think we're going to be able to fund and close those just as normal as long as the customer is currently working.
Yeah, I mean, I don't really have anything to add from what everybody's been saying. Again, I think we've got to be thought leaders, right? We've got to be positive. We want to be realistic, but we also want to be leading our buyers and be a positive voice that's telling our market, that's telling the people that are looking to buy and sell that this is temporary, this is a hurdle, this is real, we got to deal with it. But life will return to normal. We will recover from this. We recovered from 2008. We recovered from September 11th. We recovered from, you know, other crunches that we've had in the past, and we're going to do it again. And we need to be leaders. We need to be thought leaders and encourage our clients to keep fighting for that dream of owning their home. And yeah, I guess that's just a lot of fluff, but I mean, I think we need to be leading from the front and be encouraging to our clients, and yeah, all the things that you would do normally to encourage clients to make sure that they're living financially responsible, that they aren't, you know, going out and getting new financing on things without telling their lenders, like Eli was talking about. So yeah, I mean, I think that like everybody said, you know, a lot of business as usual kind of things, and certainly we're going to look back on this time period and see it in the rearview mirror and not want to go back to it. But definitely it will be in the rearview mirror before we know it.
I have a question that came in. Would it be fair to ask for more closing costs for FHA buyers to buy down points since rates are higher? Does anybody want to take a stab at that first?
I can do that, Amanda. That's a great question. I think as the liquidity of the FHA marketplace is up and down, that might be a thought process to, number one, making sure that we have enough money to cover closing costs for those who have limited resources to get into a home. Make sure that you talk with your loan officer ahead of time when you're making the offer of what they are actually going to need based on today's scenario. And then that way we can make sure that we're taking care of the customer as well as getting the home sold. And that's what we want to do in this case scenario. So not necessarily, we are finding some issues that is a little higher and sometimes it's not. So just get with your loan officer on that and just make sure that, that you have a conversation with them before writing the offer.
And I would say, and sometimes the agent's gonna know better. I mean, it's all great if we can get, if sellers want to, you know, can do that, can get more money to help buy some points down. I guess on the other aspect, I think agents are wanting to put their best foot forward as well. And so you might have an offer that comes in with, hey, we want a full 6%. You might get an offer that comes in that they only want 3.5%. So it's case by case. There's no really silver bullet answer for that question. Even if rates are higher, I mean, it all comes down to the numbers. You know, do they have the income? What's their debt to income ratios look like? Do they have enough for their down payment? Are the closing costs being met? So, and then are they putting themselves in a good position, submitting a good offer that will get accepted? I mean, there's all those kinds of things to think about. So, but it's a great question, but I wouldn't say that that's a definite yes. Yeah, ask for more closing costs. It's not that simple, but it doesn't hurt to ask if you need to.
One more question here. Is FHA financing basically on hold for now?
No, it's alive and well. We still have that aspect to work with. I think everybody else will agree with me that has programs, FHA is still available. You just may see some rate differentials where we were always kind of really comparative from FHA to conventional loans on rates and those type of things. You may see a little bit of rate differential between a conventional and an FHA due to the liquidity issue. But we have availability of doing that, and we expect to continue to have availability at this point unless we hear differently.
We currently have availability too. I do think that is a question that we're answering kind of as a group right here that might not be an answer that every lender in the business right now is going to be able to answer yes to. So I think it's something to still think about. I think you can let your buyers know it's out there and you can try to help them find someone that is doing that, is doing the FHA loans. But there are some people that are cutting down on the government loans out there. So I think that maybe, you know, the people on the call today have access to government loans in some way, shape, or form. Might not be accurate everywhere. So you might want to hook your borrowers up with somebody that can do it.
Well, I want to thank the panelists for joining us today. I think we got through all of our questions. Hopefully the lenders got some information across so that they can continue to work with you guys. I want to reiterate some points that we've brought up this week because I don't think that it hurts to continue to sound like a broken record. But I want to remind all of our agents that they're not allowed to leave their house to do their job. So that includes showing vacant homes, that includes as a listing agent walking through a property and videotaping it, taking photos, whatnot. Also, the photographers are not considered critical. I think we need to use the words that our governor used, and she used the words of critical infrastructure, not essential. So photographers are not critical infrastructure, therefore they cannot leave their homes either. There are, of course, ways that you can still list and sell properties as long as you have tech-savvy sellers that are prepared to help you out in showing those homes. So we should have some information later this week on for those agents that need to collect unemployment benefits. When I last checked the website, anybody who's an independent contractor or self-employed was getting automatically denied because the state site isn't able to accurately take down that information. So if you have applied and you've been denied, you do not need to reapply. If you haven't applied yet, just hold off until we know exactly when the site will be up and running. For anything else, any kind of immediate information, of course, we always send out in the Facebook group, and everything else we will be sending out in a weekly wrap-up that you usually get. So if you have questions for any of the staff, the best way to contact us is via email. Our voicemails are not necessarily coming through all that quickly, and we can answer you much quicker via email than we can voicemail. So anything else? We hope to see you again tomorrow, and we will be talking with the appraisers and how the appraisal process is going. So if you have questions for the appraisers, be ready for them tomorrow. And once again, it'll be at 12 o'clock. Thanks, everybody. Have a great day.
Hey, thanks for having us on the call, Megan.